Good morning, welcome to Ainsley News. It's Monday the 23rd of November. Today we're talking big gold outflows, big Bitcoin gains, hedging Goldilocks. As gold has tracked sideways for the past few months, Bitcoin has been grabbing attention since it started taking off last month, with the weekend seeing it a whisker off taking its December 2017 all-time high of US $20,000. It's currently sitting at 18,500 at the time of writing. And since hitting its all-time high of US $2,060 in August this year, gold has come off slightly and has held strong at $18.50 an ounce. Check out this next chart here showing the disconnect playing out between gold versus Bitcoin. Whilst flows of gold into ETFs have slowed in the most recent WGC report, Bank of America Merrill Lynch has just reported what they calculated as the biggest weekly outflow by value from gold ETFs on record last week at nearly $5 billion. Check out this chart here showing the largest outflow from gold ever. Very interesting. By weight, it was nowhere near the highest, but still significant. As per these next charts will show, in weekly gold and silver flows in all transparent holdings, which include ETFs and COMEX and other reporting entities. Here's that gold chart here for transparent gold holdings. And here's that silver chart here as well. In presenting the gold outflows chart previously, Bank of Merrill Lynch America warned that this is likely transitory, as the realization that the Uber Goldilocks scenario, playing out through gold outflows, where the market believes in 2021 being a year of vaccine, not virus, and a year of reopening, not lockdown, and a year of recovery, not recession, is unlikely to materialize. Instead of what they call the hedging Goldilocks scenario, with both metals and Bitcoin surge higher, and the realization of, firstly, supply bottlenecks in goods, services, and labour fails to keep up with an unexpected surge in demand. Point 2, excess debt. Global debt now at 277 trillion, or 365% of GDP, causes the US dollar debasement. And point 3, Fed desperation to prevent disorderly rise in bond yields sparks self-defeating disorderly asset price inflation. JP Morgan joined in predicting a double dip scenario of a negative 1% GDP print next quarter on the back of the second wave of the US. Their chief economist, acknowledging purely monetary stimulus and pent-up demand had powered the US economy through the July coronavirus wave, and then went on to say, at that time, the reopening of the economy provided a powerful tailwind to growth. The economy no longer has that tailwind. Instead, it now faces the headwind of increasing restrictions on activity. And the holiday season from Thanksgiving through New Year's threatens a further increase in cases. That's COVID. This winter will be grim, and we believe the economy will contract again in the first quarter, albeit only a 1% annualised rate. Whilst optimistic on a bounce, therefore or thereafter, it is on the assumption of a more fiscal support, which, given the impending political tie-up between the House and the Senate, and last week the US Secretary of the Treasury controversially ending the Fed's crisis lending tools, looks more and more unlikely, and hence their proviso. If instead we get no more fiscal support, this year's massive fiscal thrust is set to turn to fiscal drag. For example, in this next chart we're going to show, we're presenting the fiscal impact measure developed at the Hutchins Center of Brookings Institution. If we get the fiscal support we expect, that drag gets dampened and pushed back, allowing a vaccine more scope to boost growth. Check out that chart here and forecasts there. Fiscal policy impact on GDP. Interestingly, it was only a month ago that JP Morgan said that Bitcoin could double or triple in price, which at the time was $13,000 US. They also saw the potential for younger people to be more likely to buy Bitcoin over gold as their hard asset play. Ainsley Wealth makes swapping between bullion and crypto extraordinary easily. Seamless and well documented for your accountant or SMSF, and there certainly has been a rotation happening of late. Of course, we also just as easily and securely trade crypto for and with AUD up to any amount by bank or cash. What is clear, however, is that whilst Bitcoin and Ethereum are shooting the lights out now, there appears to be little on the horizon to suggest gold and silver won't join the party of the Goldilocks hedge that Bank of America Merrill Lynch talk of. When you see such big market sentiment moves with so many obstacles in the way, it's often good to think contrarian. Raoul Pal summed it up nicely in his latest. Just remember, the speculative short positions in bonds is the largest in all recorded history. If those speculators are wrong and reflation isn't coming, there will be a bloodbath as short positions get stopped out. There's that chart here. And in concluding, it's going to be an ugly winter. So let's try and make some money in a bad situation. Dear God. Well, thanks for joining us to start this week off. Remember AinsleyBullion.com.au for all things physical, gold, silver, and platinum. Check that out too. There's a couple of platinum coins in there to check out. AinsleyWealth.com.au for all things cryptocurrency, Bitcoin, Ethereum, and all of those large cap cryptocurrencies. And Gold Silver Standard, our own, built and backed by Ainsley Bullion, physically reserved assets, the gold standard and the silver standard. We'll catch you tomorrow for more news.